Good afternoon, everyone. My name is Anna Griggs, and I am the Director of Marketing at Coleman Report. It's my pleasure to welcome you all to today's webinar, Navigating CRE Market Shifts from Credit Stress to Lending Solutions. Today, we're joined by a fantastic panel of experts who will discuss the current landscape of commercial real estate. We have Tim Mazzetti, Charles Krawitz, Brad Salzer, and John Winnick. Our experts are going to cover a variety of topics during the webinar, and we encourage you to ask questions throughout it. You can ask questions using the chat function up at the top there. We will address questions as we see them come in, as well as after the presentation is over. Also, we'll have a few poll questions come up, and we'll bring those up, and we like to see lots of responses, so as you see them, be sure to answer those. Thank you once again for joining us for today's webinar. We have an exciting and informative session ahead, so I'm going to pass it over to John to get us started.
Anna, thank you very much for that kind introduction. Let's get right into it. First off, just want to give you a little overview on the general economy and then tie it to commercial real estate. First off, the consumer, this is some data that the New York Fed just provided actually last week on the consumer report for the first quarter. You can see that there are some areas of concern. Credit card delinquencies are beginning to approach the levels of the Great Recession. And certainly auto loans are approaching those levels as well. But things like student loans, home equity lines, mortgages, delinquencies are relatively low. So overall, the consumer is doing okay, well in some areas and some areas of concern as well. One thing that we think is important here is I think we all believe that we're in some sort of negative credit cycle. If you go back to 2008, it took 17 quarters for non-performing loans to go from their bottom to their peak. So that's over 4 years. We've now seen we've now seen 6 straight quarters of increases in non-performing CRE loans. That's likely to continue. But from this graph, it does appear that this is going to take a while. We could be looking at another 4 or 5 years of increases in non-performing loans. It's our view that banks have plenty of capital. I will say that making decisions when you're a public bank has been difficult, especially for the regional banks in the spotlight. I think all of us agree that your first loss is generally your best loss. But obviously, sometimes when you're managing things quarter to quarter, that's a difficult balancing act for banks. I just want to highlight an area of concern. The SBA EIDL disaster loan program is by any measure a disaster. Keep in mind, this portfolio is about the size of TD Bank, to put in perspective. It's a $390 billion portfolio. These loans had very favorable interest rates, 3.75% fixed for 30 years. Borrowers got initial 30-month deferment. It is confounding that the SBA has already charged off 20% of this portfolio. To put that in perspective, credit card default rates, charge-off rates are usually 4 to 5%. Truist, similar size bank, has 75 basis points of net charge-offs. So, this is an area of potential concern because obviously there are businesses that are paying rent to CRE borrowers. So this is an area that we're certainly looking at. Let's get into Arbor, which we think this is a good example of what you're seeing with floating rate loans. Arbor largely does floating rate multifamily bridge loans. These are their 6 CLOs. And you can see how the debt service coverages have fallen from, healthy at origination, 1.3, 1.4 plus, to a 0.61 average on all their CLOs. Why did borrowers do this? Well, typically, they were getting more proceeds, anywhere from 80, 85% leverage. Banks were doing 70 to 75. So for a lot of these borrowers, a 75 basis point premium in interest rates, albeit a floating rate, was worth the additional proceeds. And you can see how much they've declined. Now, getting back to the group, Certainly they're modifying a lot of loans. Tim, you mentioned in an email to the group that these modifications have annoyed bond investors. What's going on?
Well, the biggest issue is obviously in the shorter term floating rate CLO market. What's happened, John, is some of the modifications that are hitting with very little explanation are in essence providing long-term extensions to borrowers. And the question that the senior bond investors have, which are very sensitive to duration, they obviously invested in the market and in bonds at very low interest rates. They want to get paid off. And so their irritation, their anger in some cases is, hey, if these loans can be paid off, pay them off now so I can redeploy my capital as opposed to being stuck for another 2 or 3 years in these extensions. So there's a lot of frustration right now, and definitely frustration between what I would call the investment grade senior bondholders and the lower class bondholders. The extend and pretend is in full swing right now. Because a lot of people expected that if they could lend or they could refinance at lower rates when the Fed lowers rates, that they could get a better deal. So let's go ahead and extend and wait for a better day. The question now becomes, are we getting to a point where there's going to be an acceptance that rates are going to be up for a while? By the way, John, Arbor, I think, I don't want to pick on Arbor, but they have a reputation of being an aggressive lender. I think if you looked at more traditional mixed CLOs, you wouldn't see obviously the declination, if you will, in DSCRs as bad as what Arbor is currently suffering. Multifamily is definitely one of the asset classes that is having some major issues right now.
John, you're on mute right now.
Brad or Charles, any thoughts on that?
About you being on mute? I kind of like it, John.
So look, I think there are pockets of multifamily trouble, maybe even more than pockets, but in general, there's not enough housing out there, and multifamily and real estate in general is a very local business. And I think there's plenty of examples of markets where multifamily occupancies are very, very high and rental rates continue to increase. I know we like to glom on to headlines that say the sky's falling and have kind of pithy expressions about extend and pretend, but I don't see that as the marketplace. I think lenders are very cognizant of the issues in their portfolios and are diligently working with borrowers to get principal curtailments and to right-size loans in response to the new interest rate realities.
Thought it'd be a good time to bring up the poll question. We had asked this question, the exact same question in our last CRE webinar with a similar panel. You could cue that up. CRE in 24 and beyond, is it a Cat 5 or a mild storm? No storm, mild storm, more than a mild storm, not a Cat 5 or a Cat 5?
Oh, real time.
No one has said no storm.
I view what's going on right now as a slow-moving train wreck. So I voted more than a mild storm, but not a Cat 5. I think a Cat 5 would be the great financial crisis when there was way too much lending, way over lending, way poor underwriting, and just a significant downturn in the economy. The caveat I have is right now the economy is doing very, very well. What happens if we do get a recession and even a severe recession? Who knows? Exogenous events. And that's obviously a big question mark, because if the
Brad, you a
economy
Cat
hits
5?
this,
I'm a Cat 5, John. Yes.
are you really?
Yeah, I'm a
Come
Cat
on,
5. And no, real estate is a highly leveraged business. And I want to take a minute to talk about the interest rate shock that we saw starting in March of 2022. And I went back from the Fred information that I got, and I'm using prime as my benchmark because it's easily definable and defensible. And the average prime rate from August of 55 through through today is 6.83%. And yet from the great financial crisis, and I benchmarked that as 12/14 of 07 through the increase of rates in March 16th of 22, the average rate was 3.75%. And a lot of great real estate deals got done in that 14.2% year. And now, we're up at 8.5% for prime. And I think the seismic shift, when we underwrite at these new higher for longer rates, and I do think that we're capitulating now, and I've looked that definition up, surrendering to higher for longer is going to make a lot of loans out there upside down. And, I agree with Charles, frankly, on the multifamily side that demographics will win over time. But in the short term, even in multifamily, the darling of the asset class the last 8 years, there's going to be some really tough times ahead. And how we deal with that is what we're trying to figure out all together as we move through the new normal. So.
One of the things that strikes me about kind of the alarmist nature of the business and the headlines, it disregards the fact that people made a lot of money over the last 10 years owning commercial real estate. And real estate, generally speaking, is a long-term investment. So now we're at the part where investors are having to reach in their pocket and take some of those excess and oversized returns out of their pocket and put it back into the asset. But this isn't how it's going to be forevermore. There will be times when the cycle turns again and people are back to putting oversized returns into their pockets. So no one likes kind of where we're at here and now, but it's transient.
Yeah, well said, Charles.
Hey, Charles, I did see a posting on LinkedIn that your organization was expanding into the small balance CRE sector. What type of opportunities are you seeing there?
Yeah, so we're very new to this space, but we have a group of professionals that have been in this business at various points in our career in a very meaningful way. Many of my colleagues and myself hail from LaSalle Bank, and we were heavily involved in small balance lending activities at LaSalle. And in general, what we've found is that we have a great origination team, fantastic underwriters, great portfolio managers, and to be able to put that expertise, to bring that expertise to bear in the small balance space, there's opportunities to be had. So we're out there targeting multifamily, mobile home parks, and self-storage. And we think in particular in the self-storage and mobile home park space, we will meet with great success. In the multifamily space, there's a lot of others that kind of play in the small balance segment. And while we hope to win business through commercial mortgage brokers that know us and love us, and just the ease of processing a fixed $20,000 fee associated with it, we're not 100% sure that we'll get the same traction in the multifamily space as we will in the self-storage and mobile home park spaces. But this is meant to be a national lending program. We'll lend in tertiary markets, provided the MSA population is above 100,000. on mobile home parks and self-storage, and then sticking to primary and secondary markets for multifamily.
And Charles, your definition of small balance is what?
2 to 7.5 million.
I think there's a great market for that product right now.
Yeah, this is the traditional space that credit unions have played in, and we are approaching this in conjunction with some other credit unions who have an appetite for this kind of product and want to leverage off of the strengths of our platform that I mentioned earlier.
Terrific.
Let me stick with Charles for a minute. With respect to new commercial real estate loans, how are you underwriting new commercial real estate loans today? Are you stress testing to higher rates, or you kind of feel they're not going to go any higher? How has your underwriting changed?
Right. So the bread and butter of our business really is, call it the $15 to $35 million commercial real estate loan in multi-tenant industrial, mobile homes, RVs, student housing, and multifamily. So with regards to stress testing, we look at each deal on its own merits, and we examine, the risks associated with it. So am I concerned about interest rates? Sure, I'm concerned about interest rates. I'm concerned about rental rates. I'm concerned about rising expenses, namely insurance and taxes. So try to really take a holistic view of the cash flow rather than just honing in on one element and letting that be kind of a programmatic feature. So we avoid that and really try to engage in a bespoke review of the merits of any lending opportunity. And it served us well.
Real estate's a local business. I mean, and if ever it was market by market or sub-market by sub-market, it's today. And so I'm sure Charles will do great with this new platform. I think that timing for the launch is perfect.
Good, thank you, Brad. I hope you are right. I think you're right. We have a big following of commercial mortgage brokers that we've done well by for many years, and we'd like to parlay their trust.
Right. Brad will be there if any of those loans don't do well.
That's exactly right. Which leads me to a question. I mean, what are we doing with price discovery these days? I mean, there's so few transactions.
That's an issue.
I mean, that this price discovery really is your underwriting, Charles. All these great new deals. That seems to be an issue that we're facing with now as banks, and we've seen a huge inflow of deals coming in from banks asking us. I don't know that they're ready to trade them, but I do think they're asking us to put a number on it as they make the decisions whether to hold or sell the loan.
Yeah, that's Brad. That is great. The Trepwire, I'm sure many of the folks participating or listening in on this webinar probably listened to just this week. We're talking about, hey, let's not kid ourselves with valuation precision, 73.4%. That's not how real estate is, and that we're probably better served thinking about value in terms of ranges. And I really liked what they were saying on the Trepwire this past week. But you're right, valuing property in this marketplace is really difficult, particularly if you're going to exclude from that valuation the non-arm's length transactions. And one would argue that there's very few of those going on in the marketplace right now.
Right.
Well, while you're on that topic, let's talk about appraisals. I mean, one of my clients once said to me, an appraisal is outdated the day you receive it. Obviously, it's not an easy job in this market when you have few transactions. Brad, how do you look at appraisals?
I don't, John. I don't, because I think what our success has been at Redstone, particularly when we're buying existing loans from banks, which is our primary business, we have got to develop our own cash flow. So the appraisal, as you pointed out, is yesterday's news. It's a great benchmark, just as assessed value is, just as some of the tools that we use for establishing value. And I still love seeing what the transactions are looking like, but we have got to build the cash flow from the ground up. And that in itself is difficult, as Charles alluded to, with the operating expenses being what they are. And this is a fun one, particularly in the multifamily, the rent, the year over year rent growth was so phenomenal. Now we're seeing, flat to negative, even in such a robust market as Tampa, Florida, where I am. So we've got to get into the weeds on the numbers. It's that.
Yeah, I'd also add that appraisals are often reliant on both the cooperation of the borrower and the borrower's ability to provide the appraiser the information he or she needs. And for distressed assets, for example, you may not get any borrower cooperation at all. So the appraiser is just guessing as to what rents are and occupancy is, so on.
Well, we have to get an appraisal as part of the CMBS process, and we struggle with that hugely. And if you think about it, some of these deals, especially, our portfolio is made up of a lot of SASB deals, single asset, single borrower, very chunky, large deals. And the loss severities, you pointed that out earlier, John, could be huge. And obviously that you now are dealing with an appraisal reduction event. You have a change in the controlling class. And so we're relying very heavily on the local borrowers. As you said, Brad, you got to go to whomever lives, eats, breathes in that market, even for larger assets, to be able to understand what is really going on given the lack of real transactions. Because an appraiser is going to cover themselves and basically use whatever cap rate or whatever, information they can gather, and then, give you all the assumptions around that. But it's a really frustrating process for our workout guys, because at the end of the day, we may have a view of value, not too different from what you have, in the sense of deriving it through discussions with people in the market and what our view is. And yet we still have to get that formal appraisal and present it. And that appraisal very often will drive that appraisal reduction event. And I can't tell you how many difficult discussions we've had with investors up and down the capital stack, obviously the controlling class, arguing with us saying this appraisal is BS. It's not an easy situation right now. The question I have for the group: when are we going to see a pickup in transaction volumes?
Yeah. Not answering that question, Tim, because I don't know. But with regards to an appraisal, sorry, it is amazing to me if a property is east or west of the Mississippi, the difference in valuation. So properties that are west of the Mississippi suddenly are worth a lot more than east of the Mississippi, yet debt service coverage is about the same, and the prospects for that debt service coverage is about the same. I've always been a big believer in debt service coverage at the end of the day. That's really what tells me whether I'm going to get repaid as a lender, not necessarily an appraiser's view of value, albeit that is a factor that goes into our lending decisions.
Yep.
We're
Well,
back to
speaking of
cash flow.
NOI, yeah.
Back to cash flow.
Speaking of debt service coverage, obviously you're looking at NOI. The next slide up here, this was a report that Goldman actually put out this morning, and it was a good report. I encourage you to read it. It's available free online. But I thought this one chart was interesting. These are basically commercial real estate top line fundamentals. So you can see 17 different property types. You can see the market cap rate, the sales price per square foot, the occupancy, the rent, the rental income growth. And one thing they pointed out is look how well LEED certified Class A office buildings have done based on admittedly a limited amount of transactions. But obviously this does not take into account expenses. And I'm a little skeptical of the rents in these types of surveys because there might be things like concessions. But what are your all thoughts on what Goldman put out?
Well, certainly in the Class A office building, and we're seeing this again, going back to our heavily weighted SASB CMBS portfolio, which is comprised of a lot of large office deals, Class A, you're going to have a flight to quality. That's happened all over the country, right? You can basically upgrade and take less space in a better building, which also goes towards employee engagement and being able to hire and retain people, et cetera, et cetera, et cetera. So you're definitely seeing that flight to quality, and obviously this, this report here shows that. Where what we're struggling with, again, going back to local markets, let me tell you, if you've got a downtown LA office building, I don't care if it's the best building in downtown LA, you're dead in the water. Because why? You've got 3 or 4 other submarkets, Century City, Santa Monica, the Sepulveda corridor, that are so much more attractive to people that downtown LA looks like a ghost town. And you compare that to a downtown San Francisco and a downtown Chicago and a downtown New York or Manhattan or whatever, and they don't have the competition that a downtown LA has. So this model here, or this report, would not apply to a downtown LA because it's tough to get anyone to move there right now. Yeah, it's a real bloodbath.
Charles, this conform to kind of your nuanced view on commercial real estate? Some areas are doing okay, some areas pretty well, some bad.
I mean, yes, but it doesn't really touch on, the local dynamics as much when you have these broad groupings, these broad categories. Interesting information, nice to know for sure. I don't think there's anything here that's super surprising. And I wonder, so they're benchmarking this, John, off of these increases in rental income change since it's hard to read.
It's Q4 2022. So in essence, okay. The last 18 months.
Yeah. Wish I had some great takeaways from this, John, other than I'm relieved to see a lot of green on the far right.
Well, yeah. One quick comment here, going back to what Charles said earlier. What goes up must come down. It's funny to me that when you look at the pandemic, hotels were absolutely dead in the water. Guess what? They've come back with a bang. Business travel is strong. And obviously in the case of hotels, look at Manhattan. You can't find a hotel room for under $400 now. There's been a huge number of rooms that have been taken off the market. And so yeah. I think the same thing's going to happen with office. As bad as office is, and that's my slow moving train wreck, it will come back. Why? Because I think you're going to have a whole bunch of C and D quality office get moved out of the market, no different than what happened in retail. And if you look at retail, where is it there? Strip center, it's doing well. And so, look, every property type is going to go through its cycle. We're even seeing some softness in industrial. Obviously, it's still a very well-performing property type. But I think the same thing's going to happen with multifamily. You had a huge amount of new product come online. Some of it's still coming online. It's going to be dependent on the local market. And I think once you stabilize and get a handle on expenses, and you're going to be able to underwrite some good deals, and they're going to perform well going forward because of demographics.
I mean, echoing what Tim just said, don't write off real estate. During COVID, student housing, people are never going to go back to school. They're going to learn online. They're going to school's so expensive. They're going to maybe go their freshman year and their senior year, and the rest of it will be online. It created a great opportunity for us to run, headlong into that storm. And we picked up a whole bunch of great multi-student housing lending opportunities that I'm thankful for because it was a coming of age experience and people are back at school, lo and behold.
Yeah. Now to get to a little bearish side, I hope all of you could have seen all the spirited emails we went back and forth where we were sharing articles and things we saw. Brad shared with us offline this apartment complex in South Tampa, which you could see the seller had paid $115 million for this asset in 2022, 444,000 unit, and sold it just a year and a half later for 83 million or 320,000 per unit. The property assessed value is 91 million, so a discount to that. Brad, what's going on here? Is this a reflection of some of the challenges in multifamily in your backyard?
Well, I mean, I'm fascinated by this trade because one, it's multifamily, which has been the darling of the asset class, and two, it's in Tampa, and we've had such in-migration and such moneyed movement into this market that to see this, $32 million hit is kind of surprising. This office is diagonally across from my own office. I'm sorry, this multifamily properties diagonally across from my office building in a very prominent and good area, solid area of Tampa. I think it's more a function of the debt and the debt service as this thing came to maturity. As I looked through public records, I see that there was an amendment done to the mortgage that extended it. And I think they saw a bullet coming and just needed to get out from under it. But I am following multifamily very closely, mostly because as the darling of the asset class, everybody jumped into it, right? That's the place to be. And as Tim just said, we simply became oversupplied, and that's causing some opportunity and short-term softness, because I do think that demographically, multifamily will absorb over time. So it's fun to follow. We tend to be lemmings. We want to be where our friends are and in vogue with that product type. So we jump into it and then we get oversupplied. So it shouldn't be a shock, but that's what we're seeing. I was just in Dallas last week, and that market is the prognosis for the DFW market and Texas in general, I think, is fantastic. But I was there chasing multifamily opportunities because in the short term, there is going to be some dislocation in the refinancing of these, particularly with the headwinds in operating expenses.
Hey, Brad,
So
I may be old-fashioned and old. 444,000 an apartment unit? God, that blows me away. That's like Manhattan.
And Tim, I think what the question is that no one has asked is, hey, maybe these guys paid too much for this thing in 2022. And that goes back to, 3.25 caps, 4 cap. I didn't look up to see, I think I can, what the cap was at the trade in 22. But yes, when we were overpaying 3 years ago because it penciled and the capital stack worked, I think we will see some short-term opportunities, at least in my space of note buying, given the last 14.2 years.
Hey, Brad, you just said 444,000 seems kind of insane. How do you feel about the 320,000 that it sold for?
And it's a great question, Charles. And what I don't know is what the cash flow looks like and how I would stress that cash flow given the increase in rents in this marketplace. I mean, this affordability issue, and I don't mean to digress, is real in many of these markets. And how we deal with that, no one knows right now. But I would love to pick apart that cash flow and see what kind of debt service coverage ratio it would produce for you.
Yeah, what kind of cap rate too?
Yeah. So
in a 578 square foot apartment,
yeah,
you're good with that. That's a standard. That's a standard that you think is acceptable.
Well, the market's paying it. I mean, it is unbelievable. I'm looking at a deal right now, and I couldn't believe I don't even remember which market it was in. Philadelphia. I was looking at underwriting a deal this morning, and I cannot believe the rents in Philadelphia. I mean, $325 a foot. I mean, when I'm old, maybe not as old as Tim, but I'm old, and I'm just telling you, we thought 92 cents was a lot per square foot for multifamily rents when I was growing up.
You know what?
Just
Don't get Don't get me wrong, I love these 578 square foot apartments. As I said earlier, I lend a lot on self-storage, so people have to put their stuff somewhere. Not in their apartment, clearly not in
That's
their
right.
apartment.
Good
No
point.
room. No room.
Just got some data for higher losses given default. One thing that does seem apparent is while delinquencies have remained low, the assets that are being resolved are seeing some pretty dreadful recovery rates. People always ask, why do I use CMBS data for things like recovery rates? You can't get the bank data. Banks can't tell you in their office portfolio, their multifamily portfolio, the 10 assets they resolve, what their average recovery rate. So we go to the CMBS data, and keep in mind in CMBS, the servicer is advancing money to the bondholders, and that money gets paid back first. So that's why you see 100% loss severity on 255 Rockville. But you could see the 3 loans that were resolved, albeit this is a small sample size, we're talking some pretty harsh loss severities. What do you all think? I mean, it does seem like losses given default may be higher in this cycle.
Yeah, well, and again, it's exacerbated because it's CMBS, which typically attracts, lower quality real estate, maybe less experienced sponsors or lower quality sponsors. And as you pointed out, John, you've got all sorts of expenses that get tacked on a workout. You got the special servicing fee, you've got the advancing interest at prime or prime plus for the master servicer during the period that they're advancing for property protection expenses and bond payments to the investment grade. You've got all the legal fees, and trust me, there's a lot of legal fees in these deals because they're complicated. You're playing within a very defined, structured deal in a REMIC. And so it's possible. This reminds me of the great financial crisis where you had bad lending and you had 100% losses because these things start running. And before you know it, you're blown through. But it's interesting. What I'm really focused on here, you've got office. And I'm guessing, I started reading this, it's very small print, but I'm guessing this Rockville, Maryland office was an older C quality office that lost a major tenant. Guess what? You got an empty building there. You got no value. You're looking at a retail in Topeka, Kansas. I'm sorry, I've been to Topeka. I used to live in Kansas City. That's not much to talk about. And you've got a mixed use in LA, downtown LA. What did I just tell you? It's not surprising to me that these properties are like literally teardowns. And so 100% loss doesn't surprise me that much in a CMBS deal, unfortunately. It is a little remindful of the great financial crisis. And you showed that graph, John. How far up the scale are we going to go over the next 2 or 3 years of increasing defaults and losses? It's going to be interesting.
Well, and what I'm hearing you say too, the optionality is not long in the CMBS world. It is in maybe some of the traditional other lending platforms. And to the extent that there's a clear path forward, I mean, that's what we're trying to determine with our borrowers now. And as we're looking to acquire debt from some of our bank relationships, I mean, what is the path forward? And is time going to help the situation, or are we just kicking the can down the road? And to the extent that time, I mean, Charles is right. At the end of the day, we want to own real estate. I mean, that's what I do. And so I want to own real estate, but I got to know there's a path forward. And some of these products, as Tim just outlined, whether it's CMBS or not, maybe they're markets you just don't want to play in.
Right.
Yeah. Now let's pull up the poll question. Bankers only, which area are you starting to see signs of credit deterioration? I apologize, we can't have 20 categories here, so it's somewhat.
I think it's great that it says names not recorded. That's the key. John, what's CRE? I mean, is that all of it together?
General commercial real estate,
Okay.
office particular, C&I is,
And
C&I,
construction.
structure
Okay.
be all construction. Nothing surprising here, fellas, huh?
Nope.
And some are saying no signs of deterioration. I mean, you are, to be fair, there's definitely a difference in performance amongst the smaller banks and the large banks. I mean, if you look, the smaller the bank is, the less problems they're seeing in their portfolio. Now, does that mean that the small banks are not looking hard enough? Or are their loans better, more localized? I guess time will tell if there's a convergence. But for the most part, more than half the respondents said office, but the rest kind of spread out between construction, C&I, and so on. Let's go on to CLO.
We got a hand raised, John.
Got a hand raised. All right, go ahead. Where do I find that? Q&A. Someone was asking if we would share the slides afterward. Yes, we will share the slides afterwards. Brad had, sorry, Tim, you had shared this with the group, CRE CLO loan performance. Again, we kind of touched on this earlier with Arbor. What does this mean? Looks like the special servicing rate has climbed from 2%, a little over 2% to 7.45. I'm sorry, the 30-day delinquency rate has tripled. The special servicing rate has risen as well. What's going on here?
Yeah, and again, there's no doubt about it that Arbor was an early indicator. Again, they have a reputation for being an aggressive lender, always have been, but primarily in a multifamily space. I'm assuming this covers all of CRE. And if you look at who our clients are in the servicing side of Citus's business, they're primarily balance sheet, higher yield, short-term floating rate, construction bridge, mezz, pref equity, and many of them use the CLO as a alternative financing strategy to a traditional warehouse or what have you. It's difficult to tell, and you can't really compare this graph, if you will, to CMBS. I think the pickup in both specially serviced assets and 30-day delinquencies has to do with the inability of the CLO issuer. They're running out of cash, and I think you also had you sent something out earlier about Starwood's REIT is basically can't keep up with a redemption request. They're running out of cash to be able to buy their loans out of the CLO at no loss to the investors and working them out on the balance sheet. This tells me that you're having significant strain in the CLO market. It's that slow-moving train wreck analogy that I tend to use. It's starting to happen. 24 and then into 25 and 26. I think we're going to have a continuation of this. How bad will it get? Not sure.
Can you tell us what's the difference between the CLO? A lot of folks are a little confused as far as CLO. We got a question versus CMBS. Maybe you give some color on how these differ from other securitized assets.
Sure. So a CMBS transaction is primarily related to a stabilized fixed rate loan that is bundled and securitized. And obviously the bonds are chopped up from AAA all the way down to unrated and sold. And so they tend to be, if you will, more static, and they tend to be longer term, and they tend to have very few reserves and no construction, no rehab. They're pretty steady state assets. CRE CLO is a financing strategy used by these private equity, global asset management firms, balance sheet lenders who are providing temporary debt to investors who are looking to buy an asset, enhance it, either through or even a construction loan, or heavy rehab, or, I'm going to take a Class B multifamily, upgrade the kitchens and appliances, and turn it into a Class A minus, up the rents, and then I'm going to go get CMBS financing or, agency financing, fixed rate. And so they tend to be higher risk. They tend to be shorter term. We're looking at 2 to 5 year, loans, even with extensions. And obviously, because they're higher risk, they're going to suffer. They're the ones who are going to get hit first. Now, the difference is in a CLO, because most of the issuers also hold the equity or the B piece, they have a lot more flexibility in how they work out the asset. And many of them, if there's not a lot of defaults, they'll just buy that asset out of the CLO, pay off the investors, and that's again the difference between a CLO and a CMBS. You can basically contribute and take assets in and out of a CLO, unless it's a static one, but most of them nowadays are flexible. And you can basically bring that asset onto the balance sheet and work it out there. And as such, they look a lot more like a bank or an insurance company because of their flexibility to be able to work out those assets.
Got it. Brad sent out a snarky email to the group, which would be this first snarky email, regarding the prudent workout guidance. I've included his illustration here. Your comment to me was something to the effect of, give them an inch and they'll take it. What did you mean by that, Brad?
Well, this guidance came out in June of last year. Again, we are dealing with an interest rate environment like we hadn't seen in 15 years. And so I think the regulators, and this came from the regulators, were saying to the banks, we want you to work with and accommodate, that should be in there somewhere, this accommodation, prudent CRE accommodation. And I think what many were able to do with this was, if you will, extend and pretend. And, let's rewrite this loan for another 364 days and see where the markets are. And at the time, remember, we were talking about rate cuts of 7 times this year, and then it was maybe 6 and 5 and 4 and 3. And now, right now we're at, 96.4% that at the June 12th FOMC meeting, rates are not going to be cut. So, now we've got higher for longer. We did extend and pretend, evidenced by the number of, 630 billion that was supposed to mature last year. That's now 959 billion this year. And, if we can, let's bury our head in the sand and hope it all works out. And my only question would be, when is the day of reckoning? Unless we can thread the needle and avoid the day of reckoning, which that's the ultimate win, I guess. But in the meantime,
don't think we can, Brad, because interest rates are not going to go back down as low as they were for the last 15 years.
Yeah.
I don't think this is, this guidance here is not saying extend and pretend. It's saying prudent CRE loan accommodations and workouts are in the best interest of both financial institutions and the borrower. I think if you are just extending out the date, hoping that interest rates are going to come down and transactions are going to start happening, that would be extend and pretend. But I don't sense that is what's occurring or is at the heart of this guidance. Rather, I think it is, work out reasonable accommodations that would allow for the best exit to be achieved on a particular loan. And I know from my perspective, oftentimes, I've got a debt service coverage covenant violation, and oftentimes that means some kind of capital curtailment. And whether a borrower is capable of giving me writing a sizable check day one, or whether that means that they have to work out some kind of enhanced payment schedule, it just depends on the circumstances. And oftentimes, when I have a dispute with a borrower about where a property is headed, oftentimes I'll ask for money to be put into escrow. And
Yep.
having that money put in escrow, I can then extend out 6 months, or maybe I can extend out a year. And then the money is there. And if they meet the debt service coverage covenant at that point, they get their money back. If not, we pay down the loan, and then we address any issues that arise from there. So I think just prudence and being smart rather than trying to flush a lot of properties onto the market at once, like happened during the Great Recession. That wasn't helpful. That wasn't productive.
Yeah.
Right.
Charles,
John, if I may, I mean, one of the
Yeah.
issues that I'm hearing a lot of is the LPs or the borrowers are willing to put and have been willing to put in those reserve monies, pay down the loans, as long as, again, there's a path forward. And part of that path forward, what I'm hearing from borrowers is, Brad, next, this was last year, rates will be down and I can go refinance. Don't put the screws to me. And I was buying it thinking that rates were coming down this year. Now that we're higher for longer, I think we've got to look at this and analyze it a little bit differently. That's all, because the equity is not flowing back in like I'd like to see it in the pay downs that I'm asking for. I'm getting more resistance today than I did a year ago.
And Brad, are they offering recourse? Are they offering anything in exchange for latitude, or just you should give them latitude?
Nope. They think that we're in this together and it's a bad market for everybody. It's tough insurance premiums for everybody. And the municipalities.
Brad, if we're in this together, when they were making a 20% return, surely, maybe you had 4% on your loan, but they were making 20%. Surely they cut you into some of that, right? If you're in it together.
Yes. And so now we're talking about an AB structure, right? We're doing a little bit of AB structure because that's what the market's warranting today. And that's getting fun. Admittedly, that's getting fun.
Charles, I'm curious how proactive you've been at your bank and modifying loans in which when the loan comes up for maturity and you reset the 5% rate at a 7% rate or whatever it qualifies for, that could then be a loan that doesn't cover. As a lender, how proactive are you being?
We're trying to be rational and reasonable, and that's with the expectation that the borrower is going to be rational and reasonable. So if it's just a maturity and I can't pay you off because I can't go and find an alternative loan, we'll want to make sure that they've engaged a commercial mortgage broker and that they can prove out that they have really been to the market and to show us what's out there, and a willingness to make it not just my issue, but it's a shared issue. So are they going to offer up recourse? Are they going to offer some kind of capital curtailments? What are they bringing to the table as well that would incent me to want to work with them? And we do try to certainly minimize friction, but each situation is very, very different. I was just able to get out of a loan that had not paid us for a long time. And I'll tell you, it was pretty nice collecting all that default interest at the end of the day. We didn't have to go there, but the borrower chose to be, very, very adversarial with us. And, fortunately, we were able to, prevail and come out the other side in a nice position. But my preference is to figure out how to be accommodating and have an approach that maximizes the outcome for both parties.
Makes sense. The next on your screen, CMBS special servicing rate has climbed to the highest level since COVID. I guess I would define special servicing, Tim. Would special servicing be the equivalent of workout at a bank? Would you say that? And what do you see with these numbers? I mean, one thing that strikes out is how bad were the loans in CMBS 1.0?
Well, it's not that, John. The 1.0 is the older vintage, right?
Got it.
And because they're older, what's left in a deal that might be 10 years old now are the dregs. And so you're going to have a higher default rate. And the real interesting statistic you want to look underneath that is how many CMBS 1.0, what is the universe of 1.0 loans left that haven't paid off, that haven't gone away, versus obviously the newer vintage 2.0. You're therefore going to have a much smaller subset, and special servicing rate's going to be much higher. It's pretty bad. Again, I'm going to go to the lack of flexibility with these loans, especially loans in CMBS 2.0 that were done in the last 4, 5, 6 years at very low interest rates. And they've got issues, whether it's office, retail, multifamily. They're starting to come home to roost. I still don't see it nearly as bad as the great financial crisis, but
Sure.
got some real problems.
Some of these could be skewed by big loans too. I always worry about my CMBS data. No?
Sure.
I don't think, that's a good question, Brad. I'm not sure TREP includes SASB deals. I think they keep those aside because
really?
you're absolutely right. I mean, I've got a $800 million office building that just tipped. That's one entire, traditional multi-asset CMBS transaction with 50 loans. So I don't think so. I think this is just your traditional 10-year fixed rate multi-asset CMBS.
I mean, I'm scratching my head why industrial is so clean. I mean, isn't everyone subject to these higher rates? I mean, how has industrial done this well relative to its peers? I mean, it's pretty incredible.
Well, they don't have the increases in operating expenses that you have in retail, office, and multifamily. And again, these were loans that were done more recently, because look at industrial in 1.0, 76.3%. That's why you can't really look at 1.0. But if you look at universe and 2.0, it's 0.22. Not surprising to me.
Yeah. One question here, final question. Kevin asked, for a renewed repriced performing CRE balloon loan, is the Alliant risk rating based on the DSC under the increased rate, forward-looking, or using historical debt service coverage?
Say that again, John.
There's a question for Charles. There's a question from Kevin. For a renewed repriced performing CRE balloon loan, is Alliant risk rating based on the DSC under the increased rate, forward-looking, or using historical debt service?
Increased rate, forward-looking.
Well, I think our time's up. This has been, once again, a vigorous question. We could probably talk for another hour, but I think you guys would start to drop off. So thank you so much for a great webinar. Anna, you want to sign us off?
Yeah, I just wanted to say thank you, Tim, Charles, Brad, and John, for being here today and for an excellent conversation and presentation. Thank you for addressing the questions as they came in. I haven't seen any others come in, so I think we're all set for now. But as all of our participants know, they're always welcome to reach out to me, Anna at Coleman Report, or any of us if you have any questions that come up later. So thank you so much, and that concludes today's webinar.
Thanks, John.
Thanks,
nice
everybody.
organizing.
Thanks, John.
Guys.
Thanks.
Well done.